The dollar and gold, what the experts are predicting for your financial future. The relationship between the US dollar and gold has been complex and historically significant, particularly as both play pivotal roles in the global economy. Traditionally, gold has served as a store of value and a hedge against inflation, while the dollar is the world's primary reserve currency. Their relationship is often inversely correlated, meaning when the dollar weakens, gold prices tend to rise and vice versa. Historically, this inverse relationship can be traced back to the gold standard era, which began in the 19th century. Under this system, currencies were directly tied to gold, establishing a fixed value. However, this system gradually collapsed during the 20th century, culminating in the U.S. abandoning the gold standard. In 1971, under President Nixon, which allowed for the free-floating currency system we see today. After the dollar was decoupled from gold, gold started to be treated as a commodity, and its price began to reflect market sentiment, geopolitical stability, and economic conditions. The 1970s marked a significant period for gold. As inflation soared due to oil crises and an unstable economy, gold prices rose dramatically, peaking in 1980 at around $850 per ounce. In the following decades, as the economic environment stabilized and inflation rates decreased, gold prices fell. The late 20th century saw the dollar strengthen, particularly during the 1990s, as the U.S. experienced economic growth and technological advancements, resulting in lower demand for gold as a hedge. However, the financial crisis of 2007-2008 renewed interest in gold as a safe haven asset. During times of economic uncertainty, investors tend to flock to gold, driving up its price, especially when the dollar is under pressure from expansive monetary policies, like low interest rates and stimulus measures. This inverse relationship was particularly evident from 2008 to 2012, when gold prices soared to nearly $900 per ounce. In recent years, factors such as inflation fears, geopolitical tensions, and economic policies continue to influence this dynamic. Although the dollar remains strong due to its reserve currency status, gold has re-emerged as an important asset class, with investors closely monitoring both for signs of economic stability or instability. Overall, the relationship between the dollar and gold remains a critical barometer of market confidence and economic health.